This week has been quite an eventful one for India, with a fall in key indices and geopolitical friction, but we're still quite positive about the weeks to come. Let's dive right into what's happened and what we expect. While many may be disheartened by the fall of Nifty, last week's decline should be viewed as a healthy retracement from the overbought zone post the 3-week 1,000-point rally. We expect the Nifty to form a higher base around 19,500 in the coming week, followed by a healthy consolidation in the 19,500 to 20,000 band. Volatility is likely to subside post the monthly derivatives expiry. We reiterate our target of 20,700 by Diwali, with key support at 18,900, and expect BFSI, auto, IT, power, and the consumption sectors to be in focus. Leading the charge of the falling markets, HDFC Bank plummeted this week on the back of various brokerage house downgrades and slashed target prices after the bank's first post-merger investor meet with HDFC. The management's guidance on key metrics, including margins and net worth, spooked investors, which led to the stock losing about 1 lakh crore rupees in the market cap over just 3 days. The bank has given reasonable clarity on net worth and other related matters. As of now, we believe the merged entity is trading at about 2.3 times the FY25 adjusted book. Now, for some positive news. JP Morgan is set to include the Indian government bonds in its widely tracked emerging market debt index starting June 2024. India is expected to reach a maximum weight of 10% in the JP Morgan GBI EM indices over the 10-month period. It's a move that's expected to bring in a great deal of depth and liquidity in the Indian bond markets. A 10% weight could lead to a cumulative inflow of anywhere between $24 to $30 billion from June 2024 to March 2025. Such inflow is likely to reduce borrowing costs, benefiting corporates in particular and the economy at large. Moving on to some global updates. The US Fed has left the interest rates unchanged for the second time after increasing it by 11 times by 525 basis points since March 2022 in an effort to keep inflation in check. However, committee members hinted that another quarter-point rate hike might be needed before the end of the year. Now, while there's been a lot spoken about the recent downturn in India-Canada ties, we believe that it would have minimal domestic economic impact, as India's bilateral trade with Canada is just 0.7% of India's total trade in FY23. And the trade is evenly balanced with imports equaling exports at roughly $4 billion as of FY23. Speaking of international trade, oil is not well. Crude oil prices rose to $95.6 per barrel on Tuesday, with the monthly average price increasing 24% since June due to cartelization. This relentless 3-month rise in the price of crude oil has brought it to the threshold of the psychologically critical $100 per barrel mark. This is likely to negatively impact India's GDP growth and fuel inflation, as India is a net importer of oil. Here's an interesting stat. Every 10% increase in crude oil shaves off 0.1% from our GDP and widens the current account deficit by 0.4%. And finally, here's our hidden gem for this week, PNC Infratech. The company has established itself as a strong construction player in the roads and water infra segments. Executing projects using wholly owned equipment and in-house teams enables PNC to deliver projects on time. The company's order book stands strong at roughly 18,900 crores, and we expect healthy revenue CAGR. The company expects to monetize its assets by the end of FY24, and the management expects this to drastically improve its scalability. That concludes our wrap of the week that was. See you next week.
Investments in security markets are subject to market risks. Read all scheme-related documents carefully.